Welcome to Keeping It Simple. Today, Mike Green and Harley Bassman are joined by Noel Smith. Noel is Chief Investment Officer and founder at Convex Asset Management. Noel's background is that of a market maker, academic, and hedge fund manager, and he has a surprisingly interesting number of stories with rap royalty from the 90s who may or may not be currently serving time. Noel is not serving time. The rappers are. Today, we're going to have a deep discussion on options and how zero-dated options and other financial instruments might be affecting market structure. There's a Q&A button down at the bottom of the screen. Please submit your questions there, and we'll try to incorporate them into the discussion. Today's discussion is meant to be informative. It's meant to be entertaining, but it should not be taken as investment advice. So, Mike, take it away.
All right, thank you very much. And just as a quick heads up, this is actually going to be our last regularly scheduled KISS for a variety of reasons, compliance being the single biggest one. The cost of actually doing these has risen significantly, and so we will be doing them on an episodic basis. Nobody could have finished this off better to end out 2025 than Noel Smith. This has been the year of option dominance. We've seen more and more examples of people trading in the option space. Noel, maybe you could fill us in just very quickly. What does Convex do? How do you think about the world? And we'll launch from there after you've given the very brief intro.
Sure. So Convex is intended to be the natural distillation of my professional career. I started out as a market maker, then running a prop firm, and now I run a hedge fund. So when you start out as a market maker, your job is to stand around and figure out, what's the bid and offer spread around theoretical value of an option or any other product, really. And then as a prop trader, you internalize some of those trades and you start to maybe think about taking some deltas or other types of risk. And then the hedge fund is really intended to be best practices from the market making and prop trading so that people that want to invest alongside of these ideas can also make money.
So ultimately, this is one of the things that I've seen over and over again. You and I both got started in the market making space. I was on the crude oil markets. You were in the option pits in Chicago. You build up kind of a technical expertise of things that you understand that you then start to express in trades. One of the areas that you are, extraordinarily well known for is your work in the option space. This has become one of the areas that's become increasingly dominant to it. We've got a few slides that I put together that we can hopefully share. But you and I have both been doing this for a long time now. Our large foreheads speak to that. Harley's going to show up. His has gotten larger in the last couple of weeks as well. The simple reality is that this is a different market, though, than the one we grew up in. One of the slides I wanted to start off with, and then we're going to go to some questions, is on the VIX itself. Let's take a look at, just very quickly, what it means when we talk about index options as distinct from single name options. And so when you think about what the VIX ultimately is, first, the VIX itself is a measure that is capturing the 30-day expiry options. That has changed in a meaningful way. When Noel and I started trading this stuff, there were only 30-day options, and so you were actually using a blended 30-day period. Then they introduced weekly options, etc. But within the VIX itself, there's been a really substantive change of where the volatility is being sourced from. This is showing the single stock volatility for the S&P 500 relative to the VIX itself. And the relationship between these is ultimately about correlation. Noel, when we were in the late 1990s, we had a ton of individual stocks with exceptionally high volatility that translated to relatively low implied correlation at the index level, and the VIX itself rose, but it didn't really reflect this idea of a giant systemic risk. It was much more about the individual securities. Today, we're in a slightly different world, and that's led to a change in everything ranging from how people express trades to how people replicate indexes. Can you give us any thoughts in terms of what you're seeing from the position of a former market maker, now a trader of these types of strategies? How are people exploiting this difference?
Well, there's so much to unpack there. We could spend an hour on just that opening commentary. The idea that we're talking about a VIX, which is struck at 30 days, and then the idea that there is a zero DTE, gorilla in the room changes at a minimum if you have to know nothing else about the VIX to know that the time slice that we're discussing is changing. So naturally, there's only so much money to go around. And if some of that money's attention is being drawn from 30 days to some other tenor than 30 days, and then also coupled with what is the reaction function of that paper, that does change things. What I mean by the reaction function of the paper is if you have this ocean of ETFs or other call sellers that are selling something in the 30-day tenor, what they're doing is they're selling premium or options prices at that time. But crucially, they are not hedging. So if you're a market maker A and I'm market maker B, I sell some options, you buy some options, we both hedge our deltas, the marketplace doesn't really care. But if I'm selling, 100 million options at a certain 30-day tenor, and that's compressing volatility, and then somewhere else on that options chain, you can buy volatility at a different time and at a different price. It does create dislocations, which also in turn create opportunity.
And so when we think about the difference in a market that has highly volatile individual stocks versus a market that has effectively a more common volatility. I know you work closely with the guys at Tier 1 as well. We spend an awful lot of time talking about the difference basically between the Mag 7 and the rest of the market, right? That basically the market at this point, increasingly, we have a few slides on this, but the market is dominated by those top 7 names, give or take, that make up roughly 35% of the index, and a dramatically higher portion of the option volatility as well. But the stocks themselves pale in comparison to the volatility that we experienced back in the late 1990s.
Absolutely accurate. And not only that, but the bid offer spreads are so impossibly thin compared to what they were. I remember when I was trading a stock called Rambus, we would price up 4 ways with a $4 wide spread. I mean, the markets on these things were ridiculous. But anyway, going back to your point, there is a new opportunity set, and this is always evolving. But the point that individual names like NVIDIA or Cisco or whatever are moving like crazy here and there, but yet the index isn't, is the dispersion trade. That is the point of that trade. For those who don't really know, the idea is that say you have a 2 stock index, you have stock A, stock B. Stock A goes up 10%, stock B goes down 10%, but index AB goes nowhere. So in this dream scenario, if you have a dispersion trade, you can make money thrice. You make money on A, you make money on B, and you also make money by being short volatility in the index of AB. So this trade has been going really well for us for quite some time. But the funny thing is, not to talk about my own book, we actually don't have that much Mag 7 exposure, not because we do or don't want it, but really because we haven't been able to find cheap volatility in those marquee names. So the alpha that we've generated in the dispersion trade has been with some of the secondary and tertiary names.
So, in general, when I think about the long dispersion or short dispersion trade, I put up a slide here very quickly. Long dispersion, you're effectively shorting the index options. You're buying the single name options associated with this. The way that trade goes wrong is something, systematic happens, right? We saw this in July of last year, and the clearing process was that the index volatility exploded. Right. A lot of people talked about this as the yen carry trade unwind last year. I didn't see any real sign of that. Did you come to a different interpretation? Did you see that as a big yen carry trade unwind, or did you see that more as a dispersion hit?
It's a good question. And I know that you've made some commentary about the dispersion trade blowing out. I will tell you the more accurate version of what happened for me that day. My job, as I see it, isn't really to understand if it is or isn't a yen carry trade blow up or something else. It is to figure out what to do now. And so what I did is I look at the VIX or VIX-like analogs, and I try to disentangle what's moving and where. What I mean to say by that is it skew? Is it the absolute value of the vol? Is it a parallel shift within the VIX futures? Where is it happening? And how do I decide what to do now? We have a hedging component to our book, so that did really well. Great. But do I keep it on? Do I add? Do I sell it? That was the decision I had to make that day. But because the reaction was so steep in the front end and happening before the market was open, we decided to basically fade that. And that's not the same as like the tariff situation, where there was more of a parallel shift and a more systemic vol explosion relative to the yen thing. So I've been burned by narratives that are so logical so many times that I almost ignore them. I don't really care if it's a yen carry trade or a carry yen trade. I care about what to do relative to what's in my book, and then how do I make money or lose less moving forward.
Well, and the very specific thing that we saw last July, right, that speaks to the difference. You highlighted the difference between what we saw with Liberation Day and what we saw last July. What I remember from July 2024 was an explosion in index volatility. And actually, single name stocks like Nvidia saw their volatility compress, right? Which suggests to me that it was largely a function of an unwind of this short index options, meaning you have to buy back the index option, driving index option prices higher, while simultaneously selling your single name options, driving those on a relative basis lower. That seemed to play a really key role. Does that match up roughly with what you saw in that time period?
Yes. Also, additionally, the bid offer spread on some of these things that was driving the VIX.
Mhm.
I think the VIX print was 67. I'm going off memory, so
Yeah.
don't hate on me. But it was never really tradable there. In other words, if you wanted to try to sell that 67, I don't think you could have. I think effectively what I ended up selling was in the 40s, something like that. Or not exactly, because I can't trade the VIX, of course, but the VIX futures analog. Um, and then, yes, we weren't worried about anything in our book that day other than index. So again, we communicate with words. So of course we want to talk about stories and narratives, but ultimately, all this nonsense behind me is numbers, and the numbers don't really care about the words. They just want to, figure out, how do I make money? How do I not lose money? And what we did at that time was see this sharp, steep ascension in the front month VIX future. That coupled with the really wide markets, which goes back to the market making stuff, right? You know that if the markets are really wide, the market makers are not happy. They don't want to make markets, which means that there is some mechanical financial reason to step back. And with that, I decided to fade it. And that was the correct
Well,
decision. I didn't
yeah.
know at the time.
Yeah, no, and I think that's absolutely right. That's the right way or that's the way I think about it as well. I see the market maker bid ask blow out. And effectively, they're just trying to tell me, look, I will trade with you, but I will do so only in a position in which I'm guaranteed to make money. That tells me their balance sheets are strained, their positioning is offside, etc. That's really what July felt like. Now, what was so interesting to me is that we went through an extended period where basically the dispersion trade seemed to have been taken out. We had slightly higher index volatility. The VIX was relatively elevated, telling me some capital had been destroyed in that process. But where are we today? And one of the charts that I wanted to share with you or share with the audience actually speaks to this characteristic of, is this actually putting pressure? So I'm sorry, give me 1 second here to pull this forward. I want to go to our fourth chart. Um, which is looking at the difference between effectively the volatility risk premium. Are we meaningfully experiencing implied volatility that is below realized volatility? I'll be honest with you. I've been very surprised, Noel. I hear this narrative all the time that, excessive selling of index volatility is compressing index vol. That's lowering the volatility risk premium. I'm just not seeing a lot of evidence for it.
No,
What?
that to me is total nonsense. And even intuitively, think this through. Who is going to sell you a straddle that carries for nothing or something? That makes no sense whatsoever. So if you think about this, say you're a market maker at Citadel. Everybody loves to pick on Citadel, so I will too. If you have a $30 straddle and you can collect at least $30 in delta or in theta decay, why would you do that? That makes no sense. There's no money in that trade.
Yeah.
So the idea that you're going to sell something, anything, it could be a spoon, it could be a car, it could be a ceiling fan. Why would you sell any product for a non-economic reason? Ultimately, a non-economic reason. So the
Because
idea
they're
that
retail and they're selling a location. That's why.
yeah, but
They don't look at vol.
fair enough, but retail is not going to set the market for the at the money straddle en masse for any size for any period of time. I think that is more going to be a reflection of, the Virtus of the world, the Susquehannas of the world, and the Citadels of the world. So if I want to go out and buy, 10,000 straddles at, 44 bips on the day, I don't think retail is going to fill me.
Yeah, I think this is one of the key things, and I would emphasize it as well, is just that even as large as we have seen the volatility selling space get, because of the diversity of strikes, because of the diversity of products that they're struck against, I'm just not seeing the pressure on the implied versus realized or the volatility risk premium that many of my contemporaries, basically shout from the rooftops, right? I'm just not seeing it.
Hey, Mike, haven't you run all these charts showing the profitability of vol selling programs has diminished greatly?
Absolutely, but they've diminished for a totally separate reason, which is the drift in the delta. In other words, if you sell a 1 month option, a 1 month call option, you lose money if the realized volatility far exceeds the implied volatility that you sold at, or you lose on a relative basis because the stock has appreciated underneath you. And it's that drift or delta shift that is driving the reduced profitability. It's not the volatility risk premium. Noel, do you want to clarify that or push back?
I think in essence, what you're talking about is a third order Greek, which is to say
Yeah.
that the delta changes when the volatility changes. So if you have the volatility at X and it goes to, I don't know, 0.7X, the delta will change at a rate of change faster than that as well. And the hedging function for the marketplace will force buyers to come into the market to change their hedge book. So if they're trying to be delta neutral, they're not going to be if vol goes from X to some number less than X. So what they have to do is they have to buy futures or whatever to compensate for that. And that drift is a real thing for sure. Like in the last handful of days, last week, we came in, we were along the market because of what we thought those effects would be. And I think we were correct for the correct reasons. And I think that's kind of what you're saying.
Yeah, I mean, what you're hitting on is actually a really core component. The last week is a perfect illustration. The week of Thanksgiving is a perfect illustration of this. We came into the week with volatility elevated. Holding that elevated volatility is very expensive. And so once you actually pass the point at which, an immediate catalyst is there, you basically have to trim those positions. As you trim those positions, volatility falls. That allows the delta to increase for anything that is in the money. It effectively raises the probability that it's going to end in the money and creates buying of shares in the process.
Absolutely correct. Like think about like a mesa, the side profile of a mesa where you have a large, wide distribution of prices versus a very pointy peak. The difference is that when the mesa moves from a wide distribution to a narrow distribution, those volatilities collapse at a different rate of change than the middle part. And that's actually part of the reason we work with strangles as opposed to straddles in dispersion trade, because the rate of change is different. But when that is changing, it forces the delta function. In other words, something that was a 30 delta option might end up being a 20 delta option. And now you have to buy futures to get back to flat. And that's just a mechanical thing. That's not a judgment. That's not a decision on how many, GPUs is NVIDIA going to sell. That's just math.
You think that the big market makers hedge on the delta that comes out of the option price all the time?
No, absolutely not.
I don't. I never
Yeah,
did.
I don't think they.
Otherwise, you'd just be spinning your wheels, and losing money. I mean,
Well,
I
this
understand.
is
This is
yeah.
getting this is getting way too geeky though for anybody. So
It's pretty geeky, but I actually want to hit on that, Harley, because this is one of the key changes that has occurred. One is obviously the Volcker rule, which changed the capital requirements, meaning that far less directional trading in positions could be held at the banks themselves. This has actually been one of the things that's facilitated the rise of the Citadels, the Susquehannas, et cetera, as option market makers relative to the banks. They have less restrictive capital requirements, and that's actually facilitated them growing in the space versus the traditional banks. Noel, I'll let you comment on that before I move on.
I think it's totally true. So we used to trade a ton with the banks, and we thought that was some of the best paper out there. And after the Volcker rule, a lot of those quality guys that really understood the marketplace would go to other firms like a Virtu or a Susquehanna or Jane Street, whatever. So that part of the business has migrated. And then to go back to what Harley was saying, do I think that market makers instantly hedge out their deltas to be flat at all times? I absolutely do not think that's the case.
no, my question was, do they use the implied vol of the last trade to use as their delta?
I don't think they do, and I don't think they should. I think they should have an accurate forecast of what vol is going to be. Because if you're looking at what vol is, you're probably not going to make money. You need to look at what is vol going to be. I understand that's a little bit like projecting the future, but that's kind of the job. You have to have some kind of a forward vol estimate. And I think that is the correct delta to hedge on. In other words, if you buy 1,000 straddles on Friday, do you hedge it to Friday's vol or do you hedge it to Monday's vol? That's the question.
Well, the answer to that is in part both, right? So there are people who run much stronger models based on the idea that realized vol is the best predictor, or current implied volatility is the best predictor of forward realized volatility. There's also others who I think build much more dynamic models, as you're highlighting, that incorporate everything ranging from charm, which is the decay of the change in delta that's tied to the time decay associated with the volatility. These are all things that we see, particularly over weekends or over periods in which the market is closed, that can create fairly significant changes in delta exposure with absolutely nothing really happening.
Yes, that's absolutely accurate. And I honestly think that is the job. That's kind of what they should do. Otherwise, if you were just mechanically trading off what the screen was telling you, it's pretty basic. You can probably have a computer program do that. The harder part is ingesting the new information that is continuously coming into the marketplace and turning it into something that's an actionable trade. Ultimately, as a guy who ran a prop firm, the joke but not joke question that we always ask is, okay, great story. Who cares? What's the trade? And I still kind of believe that. I think, what's the trade? Like, your story is fantastic, but I don't care. What do I do with this story?
Yeah, no, I think that's absolutely right. Let's actually flip back to the screen for a second, because I want to hit on the idea of how we're seeing correlations change and the structure of the options market that has contributed to this. So many viewers will be familiar with the work that I've done around changing correlations in the S&P 500. One of the metrics that you can use for that is effectively just looking at binomial correlation. What percentage of the stocks are moving in the same direction on any given day? Historically, that's done a phenomenal job of tracking target correlation or realized correlation. And it really started to break down in the aftermath of the introduction of daily or weekly options at first, and then full daily options. Noel, you highlighted the idea that we're not leaving delta, or we're not fully hedging delta exposures. One of the reasons why that is happening, at least at the work that we do at Tier 1, is primarily because the market makers themselves are increasingly using tools that have convex components to them themselves, like zero data expiry options. Our estimates are somewhere around 75 to 85% of the daily trading volume in the zero data expiry options are actually the dealers themselves. Do you see something similar, or do you see it differently?
I see something similar, and I think that market the thing that I would like to dispel that I've heard in the media about zero DTE is that there is just tons of these naked options floating around. And I don't think that's the case at all. I think that when market makers are trafficking in these products, they are delta hedging with other zero DTEs. And some of the most risk adverse firms that you'll come across are the firms that have a reputation for being cowboys, like, Optiver or Citadel or whatever. They are absolutely not risky when it comes to, like, what is their shock down 10% in the next 10 minutes. They almost always, and I don't want to speak for firms I don't work for, have those types of wings covered. So in other words, the paper begat more paper. And if they can't hedge it off somewhere else within that same tenor, they probably don't trade it, or they widen the markets to get to a sufficient spread price where they do trade it.
And the other thing that I would argue that we've seen is in the active manager institutional space, we largely have stopped buying tail risk, right? I mean, it has been such a terrible trade for such a long period of time that there is no sizable standing component of directional protection that is being bought that is forcing the dealers to really drive that pricing for the tails to an extraordinary degree. At least that's what I'm seeing right now, that there's just no real demand for hedging adverse outcomes.
Totally agreed. The VIX options are probably the best place for that. But I can say, and I can echo with my own book, our hedging book has been the worst performing part of our book. And we have it, so that our investors can have a mechanical understanding as to why we can't blow out at any one given time. But we typically elect to do that in the VIX calls as opposed to S&P puts, just because we feel like that the volatility component is a little bit more predictable. And more recently, I started using variance futures as well. It's a new product that the SIBO put out that I think is an interesting product. It's not really trading much yet, but I do think it's a cool thing because it has a different return versus risk profile. So those types of asymmetric products, I still feel like they still have a home out there. But you're right. The idea that everyone's out there just buying a bunch of little wingy puts to protect a book that has just been going up for years, it's just not really there.
Yeah. Harley, when you think back on your time in Wall Street and the dynamics of hedging and how that comes in and leaves, when you think back to similar periods, not that there have been that many like this, anything jumps to mind as you think about the dynamics of hedging or the cost of hedging?
I mean, what Noel just said, I found kind of interesting when he said your worst performing book has been your hedge book. I mean, is it supposed to be?
No, but I would like it to not suck.
It's supposed to suck. You're supposed to be making your money in your primary job. It's like when I buy a car, when I buy life insurance, I don't want to die.
Of course, of course.
Yeah. Well, although to be clear, your spouse may actually feel differently, and you do have to consider the objectives that she has within the relationship as well, Harley.
I suppose.
Okay, so let's jump one more forward here because there's a few slides that I don't know why I'm having such a hard time here. Okay, give me one more second. Okay. One of the things that's really changed is actually just a breakdown in realized correlation. And this is looking at market cap weight versus equal weight correlations going back over time. This goes all the way back into the 1920s. We're now seeing a breakdown in correlations based what appears to be largely on size that we've just never seen before. How do you react to seeing this sort of chart? And is this something that you were intuitively picking up or that you were aware of in how you're positioning portfolios, driving hedges, et cetera? And do you have a hypothesis on what's going on here?
I haven't seen this chart until just now, so I'm actually just ingesting it as we're talking. I don't really know the rolling 1 year market cap weight. Sorry, this is clunky. I know.
Yeah, so just very quickly here, what we're looking at here is the correlation of market cap weight indices relative to equal weight indices. This is effectively picking up the divergence that we're seeing in the size factor, where the largest companies seem to have the highest beta, the highest response. This is very much different than we've seen in the past, where we would have thought of small caps as having the greatest reaction, et cetera. That just seems to be breaking down.
Well, I think this is an artifact of the concentration by
Yeah,
the Mag 7 or top 10,
I think that's right.
whatever you want to call it. And I also think that going back to the tech bubble, people like to act like people at that time when I was trading during the tech bubble that we didn't know that pets.com was ridiculous. Of course we knew. Everybody knew. But while you were sitting there with your arms crossed, not trading it because you're so smart, the guy next to you was making millions of dollars a week trading it. So I kind of learned a powerful lesson, which is dance when the music is playing. And the idea that I can't be long NVIDIA because I'm so smart and NVIDIA can't go to $6 trillion market cap, I don't think that's true at all. I think that having a exposure to what's happening while it's happening is important. But I also think that knowing when to diminish your risk is also important, or have on positions that will mechanically save you ahead of time if there is an unforeseen invasion of Taiwan, and then TSMC is now, a problem. NVIDIA goes to a $3 trillion market cap in a day. Those types of things I think any prudent investor should have on the menu.
Wait, no, as an option trader, why do you care at all if NVIDIA is rich or cheap? It's meaningless, isn't it?
The size and the concentration and its effect on the index is how it matters to me. Whether
So you're talking for the dispersion trade then?
For the dispersion trade, but also for the index, right? Because if NVIDIA gets cut in half, the index is going to go down, 15, 20%, maybe not that much. It is such an outsized, that whole group of names has such an outsized influence on what's going on. It's irresponsible to not have your finger on the, eject button at all times if you need to. But you're right. Whether it be NVIDIA or something
theoretically, your single stock book's going to be weighted weighted proportionally to your SPX book, isn't it? Do you trade when you do the dispersion? Do you do theta weight or gamma weight or vega weight? What do you do?
Vega. We do Vega weighted. And as I mentioned in the opening, a lot of these big names aren't in our dispersion book. And it's not because I I care. It's just that, the value when we're buying single name options, what we're looking to do is buy something for less than we think it's worth. That could be anything, right? I could be, new aluminum siding for my house. I want to buy it for less than I think it's worth. So when we're buying options, we're trying to find value. And oftentimes that value is not to be had in some of these big names that are moving around quite a bit. So they end up not being in the book. And sometimes it's great and sometimes it's not. But when you have these options that are in high price names, and they're also high vol names, if a week or two or three goes by with nothing happening, that can be very painful. Tesla, a couple of years ago would go crazy and then everybody would buy options and then it would just sit for like 3 weeks, just so as to kind of like punish everybody who wants to just like, I don't know which way this thing's going to go. I'm going to buy some volatility. And then boom, here's a bunch of theta for you. No thanks. Those types of trades can be very difficult. So that's why we're always looking for some kind of a relative value within our volatility portfolio.
It's also a reflexive component, right, Harley? I mean, if you pay a ton for realized volatility in Tesla, the odds are very high that you've actually subsidized dealers exactly as you were pointing out, not having to really worry about their delta hedging. Because that super high implied volatility means the delta hedge doesn't matter very much.
No, let's circle back. We're so far in the weeds here. I can barely breathe. Looking at your hedge fund over here, where you're running money for real people and taking a cut for yourself. What are the things that are right now with the current world that are most interesting to you in terms of opportunities? Maybe not for civilians to go do it, but where is the profit coming from in your book?
So our profit comes from a handful of different sources. We've got a few different sleeves. But one of the things that, when I said in my opening commentary about, to try to distill all of these Rube Goldberg type of contraptions into something that's simple and actionable, it's not so much that we're trying to out-clever the marketplace, because that can be quite difficult over long periods of time. It's more that we can try to avoid some of the catastrophic or even minorly disappointing losses that can change the math in your book. So if we can perform roughly with the market, call it, 0.8 to 1.2 within the market, but when the market goes down, we can do something like not get our asses kicked at any one given time. If the market's down 10%, maybe we're down 2 or 3. And then over time, that—
You're talking about owning SPY and then overlaying an option strategy to go and have it do better in a down market.
Yes, sometimes. Owning
As opposed to an
SPY—
absolute return fund that makes money irrelevant with low correlation to the market.
Sometimes correlation is not a problem, but sometimes it is. Our correlation is about 0.3, 0.4, and it's spurious. So what that means is that it changes with time. It's dynamic. So our correlation can be high if VIX is at 12 and everything is fine. We don't consider beta to be a naughty word. But if the market's going down or chopping around, our correlation will go down, and beta is not something that we want. So we try to pre-answer for all of those.
You want to be 80 to 120% of the index. That's all beta.
When beta is appropriate. When beta is not appropriate, we want—
So you choose beta when you want to and absolute return when you want to.
Correct.
So when you bring in the money for the customers, what are you telling them you're doing?
Well, we try to, show them exactly that in the methodology and how we get there. So what we're trying to show them is that we have, modeling and signals from the options marketplace, because we think that the options marketplace is probably overall the most clever and superior source of knowledge, because it's a forward projection of what's going to happen. So what we're doing is we're trying to take that information, much like you would as a market maker, and say you're standing on the floor of the exchange making markets and options. Well, you're getting a lot of information other than the option prices. And you can use that information to kind of inform the rest of your trades. Sometimes the best way to express that trade is in the options, and sometimes it's in the underlier. And it's really a function of where's the volatility and what do you think is the best way to do it. So what we're trying to do is selectively have beta from time to time. We've gone through an extended period recently where beta has been fine. But if the market chops around and the VIX is at 22 for 6 months or 6 years, that's not going to be like that at all. So
if SPOOS is down by 20% over a year and you're down by 8%, are your clients high-fiving you?
I don't know. So it depends on the vol path, right? 2022.
They don't care about the vol path. They care about they gave you $100. They want to get something back.
You're right. But my retort to them was going to be COVID or 2022. In 2022, we had a relatively low vol, market down 20%. During COVID, we had an extremely high vol, market down 20%. Those two things are pretty different for our books. We made a ton of money in COVID and we lost money in 2022. And the reason is because we were actually short the market by being long puts. And those long puts did not pay because of the rate of change in the marketplace was too shallow for us.
If I
So
was
we
to
saw,
go,
yeah, Harley, we saw something very, very similar, right? Long volatility strategies paid off extraordinarily well in March 2020. They were largely ineffectual as hedges in the 2022 time period for a variety of reasons, but the dynamic of no single drawdown effectively ever hit a level during 22. We had repeated drawdowns over an extended period of time, but the cost of expressing that in option form was very, very, very painful, I think, for most participants. It also speaks to kind of the character that we often see, which is the market is like the Maginot Line. It tries to fight the last battle. Going into 22, we had hedging exposures that looked an awful lot like what would have worked in March of 2020. It did not work. People largely swore off hedging. Now, as we look at similar components to it, nobody's really positioned with the type of hedges that would have paid off in March of 2020.
no,
That's
if you go and sell the 1 month strangle, pick your poison every day, and every day at 4 o'clock you delta hedge, you do that for a year. Is that kind of strategy a winner or a loser in the current world?
loser.
If you go and short the second VIX, and as it goes to the first VIX, you roll it back up again. So your standard VIX roll down. Is that a winner or a loser?
Traditionally, it's been a winner, but lately it's been kind of flat. So that roll down vis-a-vis the cash VIX structure has been okay. It's had periods of good and bad, but hasn't really done a whole heck of a lot. But those two trades are different. You're talking about the volatility risk premium that's embedded in the VIX futures, which it should be, or just the at the money hedge straddle. And what's going to end up happening is even if you make money with your volatility, you're going to chop yourself up in the hedge. So
Yep.
Didn't Mike just show a chart that said that implieds are over realized vols right now?
yeah,
They almost always are.
So
yeah, but
why
you pay,
wouldn't selling
you pay what?
straddles every day and delta hedging work?
Because it's a delta hedging, right? And the market
Right.
rips up. What happens is as you hedge that instrument out, you're going to a new location at each time. So what you're effectively doing is you're moving up the curve. So it's the hedge that's the problem, not necessarily the straddle.
Okay.
That's part of the point that I was highlighting, Harley, is that it's a delta loss that's ultimately hitting you in that trade as compared to the difference between the implied and realized. All right. So, I mean, all of this is a very, very complicated way of saying that we've gotten to a point in which options and understanding these option dynamics becomes a more and more important part of the market. This is actually, I know it's very late in the presentation, and we're probably going to wrap up pretty close to normal time. Let's do our quiz, our surveys. How many people, the first question I believe is how many people have traded single name options on a personal account? And the second question is, do you buy them or sell them more? No, you don't get to answer, unfortunately.
Yeah. By the way, just walk through Belgium if there's a big wall in front of you. It's easy. The Schlieffen plan.
Okay, about 75%. And interesting, we got a long vol crowd.
Well, from a
Huh.
margin standpoint, that makes sense,
That's
right?
good.
Yeah. I have to confess I'm a little surprised. I actually thought that there would be roughly 50-50 split between buying and selling. I'm not often surprised by the surveys. Were you at all surprised, Harley?
Yeah, I would have thought people are more sellers, but I also think this audience is a little more sophisticated than most, where they
Yeah.
recognize that, I mean, when you sell an option, it's, unlimited loss, limited gain. That tends to not be a career enhancing strategy. I tend to be long convexity most of the time.
Yeah, you and I both kind of it explains our relative poverty, but also our relative longevity, right? Getting too enthusiastic about selling insurance is never really the right answer, but it does pay out over time. Okay, so that's actually really interesting. In the context of people primarily buying options, Harley, one of the reasons why I wanted to hit on this component is some of the more recent products that have been introduced, including some of our own, around things like worst ofs, which are effectively, dispersion type trades, right? They're ways of betting on that correlation component. Noel, when you think about worst of structures, exotic option structures, structured products, et cetera, how do you distinguish that from the traditional dispersion trade?
So I don't have an ISDA and I don't trade OTC. So I don't want to, get over my skis on this. I look at these products and I have looked at them as difficult to get in and out of. In other words, if you have a product that you want to participate in and it goes your way or doesn't go your way, you want to just get out of it, you want to exit the position. A lot of times the vanilla marketplace, you can create some kind of synthetic facsimile of that same idea, but also have it be more liquid. Maybe not in size, but that's really my answer. Every time I've gone into something like a variance swap or whatever, it looks cool until you realize that you're kind of, death do we part. So that's the problem with some of those things. So that's kind of why I've remained my focus on the listed liquid vanilla options.
Yeah, and it's one of the things I guess I would just emphasize as well is a lot of these products are Adult Swim. Your primary component is making sure that you are capable of making markets in these against market makers that are going to, I think the technical term is rip your face off whenever they get the opportunity to. Um, but they are areas that are, combine aspects of what we've been identifying. You're effectively taking into account degrees of correlation. You are capturing components of the hedging needs and change in market structure as you move to lower strikes, which tends to drive an increase in correlation. These are all areas that I guess I would just broadly put them into the Adult Swim category, right? So when you're playing with this sort of stuff, make sure that you're paying attention to, all of the underlying components. The returns can be fantastic. And the best time typically to deploy those strategies is what feels like the worst time, when exactly as Noel was highlighting, everybody wants to get out. Nobody wants to get in. That's the opportunity set that occasionally exists in those spaces. Noel, if people wanted to follow your work and hear more about what you do at Convex or to follow your commentary, where are the best places to find you? You're less active on Twitter than you used to be.
I don't know. I think my Twitter's pretty sweet.
All right.
No, my Twitter
Maybe
is.
you've fallen off my feed with the change in the algorithm.
No, it's probably too many pics of my kids or me doing something stupid on a mountain bike. That's
There we go.
interesting to anybody. I'm on Twitter at Noel Convex, and we have a website like convexam.com, and I'm reachable at both of those places.
All right, fantastic. All right, Harley. Well, I guess we're going to wrap it up here. Can we bring in Brian and Noel? Thank you very much for joining us. I have to confess, I'm sure everybody who is checking in has seen the various chaotic behaviors that have been engendered by my opening up another salvo in the war, this time not just against passive, but poverty itself, right? So it's been an adventurous couple of weeks. I've been thrilled to have everybody on Simplify be as supportive as they have, but it does mean that I am running on extremely low fumes. So, Brian, we'll let you take it out from here.
Thanks, guys. Great conversation. And as Mike mentioned, that's it for keeping it simple for now. Once there's some interesting topics, we may bring it back. But if you haven't seen Mike's publishing recently, it's sparked really interesting debates online. Some really great content that's being produced. So take a look at Mike's Substack. And then any questions on Simplify, reach us at info@simplify.us. So until next time.
So Brian, are you giving our audience the kiss off?
Oh, Harley. All right, well, that gives us the way to end it. We're going to blow kisses off. There you go. Thank you very much. It's been a pleasure having you guys as an audience as we did these regularly scheduled. As Brian mentions, we will do them on occasion when really interesting opportunities and commentary comes up. Thank you for paying attention.